In this video, I'm going to show you how to exponentially grow your portfolio on top of already compounding interest. Hi, my name is Josh, and I want to share a strategy that I use to combine the powers of dividend investing and option selling to grow my portfolio at a much faster rate. If you're new to options, make sure to check out my video where I break down the basics of options trading for beginners after you finish watching this video. Links down below in the description and in the comments. You can see in my portfolio that I either own or I'm working to own at least 100 shares of each stock. Currently, at the filming of this video, I make $721 in annual dividend income using the stocks down here. I can make even more money by leveraging these stocks weekly or monthly by selling covered calls. I sometimes even set aside some cash so that I could leverage it by selling cash secured puts. Currently, if I were to sell a covered call on AT&T, I would instantly make $8 by using it as collateral. And we can times this by 2 because I own 200 shares of this stock. And if I were able to do this every week consistently, I would make an additional $832 every year. And if I did this with all of my stocks, you can see how quickly my portfolio would grow. Now this is important. I only like to sell covered calls at a price where I don't believe the underlying stock will rise to by the expiration date. This allows me to keep the shares to continue collecting dividends and option premium. So you might be wondering, how do I choose my strike prices? Well, one way is to use the chance of profit that Robinhood calculates, but I like to do some chart analysis and figure it out for myself. You can see here, this is the chart for AT&T. Now, the first thing that I like to do is draw support and resistance lines. The green line here is the average cost that I bought the stocks at. The blue lines represent support and resistance. You can see areas of resistance, areas of support, and how that support turned into resistance. You could also see that we're currently sitting at a previous level of support. Next, I'll draw patterns that I notice. You can see here that we're currently sitting inside of a descending triangle, and those typically break to the downside. If you look at the volume, you can see it's below average right now, and then looking at the MACD, you can see that it's trending downwards and there's still some strength to the downside. Next, I'll draw the option strike price and expiration date. Another important thing to look for are dividend dates. Stocks get a little volatile leading up to these dates, and you can see here that we've already had them, so we're in the clear. Taking into consideration all of these indicators, and by looking at the trade information, I can reasonably believe that the stock price will not reach $25 by February 11th. If you want to learn how to use these charts or what the indicators mean, then hit the subscribe button and stay tuned for a future video on this. I also have links to some trading chart posters that I use to reference in the description below. Earlier, I mentioned cash secured puts. If I decide to use this method to generate some additional premium, then I'll take the capital and put it down as collateral at a price that I don't believe the stock price will reach at the expiration date. Now looking at the short put options, I found a strike price with a high chance of profit at a premium that I find acceptable. Then if we come to the charts, you can see that I chose the $22 strike price because of this double bottom right here that indicates strength at that level. Then if we look down here at the RSI, we can see that it's getting close to the oversold level. So there's reason to believe that the price will be brought back up if it lowers in the near future. And this is also why I chose the further expiration date of March 4th instead of February 11th. If the price does end up at or below the strike price by expiration, then that's fine too, because I'll have 100 additional shares that I can use for selling covered calls and generating more premium. This is called the wheel strategy, and it involves selling cash secured puts until they get assigned, and then using the shares to sell covered calls until that gets assigned, and then you keep on repeating the process over and over again. You can do this with the same stock, or you can change it up as you see fit. Think of the wheel strategy this way. If the market goes up, you win. If the market goes sideways, you win. If the market goes down, you win. The only way you lose here is if the stock drops low enough to where you can't sell covered calls above the average price that you paid for it. But these are dividend stocks that we're using, and you're still collecting a dividend, so you still win. By implementing these strategies on top of already dividend paying stocks, this is a way that you can supercharge your portfolio. Disclaimer, stock option premiums do not always stay the same, however, and they tend to rise or fall with volatility and market direction. If this video helped in any way, or you learned something, give this video a thumbs up so that YouTube will share it with more people. Watch this video over here if you're new to options and want to learn the basics, and watch this one over here if you want to learn more about investing.